Every year, investors face this specific period of market fog.
That's a good way to put it.
It's that 4-month stretch, roughly from November to March, where we don't have fresh, hard corporate earnings.
Right. So the market shifts. It becomes all about setting expectations.
Exactly. It's a battle of consensus. Where's the capital going to flow next?
And that is precisely what we're looking at in your source material today. We're trying to answer that the core question for the moment. In this period of building consensus, where has the market placed its strongest conviction? Which asset is positioned to be the sharpest spear in the market?
And the trading results since, say, the end of last year, and especially the acceleration we've seen just in the last few weeks, they give a remarkably clear answer.
They really do.
It's resource commodities, specifically precious and base metals, with silver, copper, and gold leading the charge.
That's right. I mean, when you crunch the numbers on their return rates, the Sharpe ratios, this segment has outperformed every other major global asset class since November.
So today we're going to unpack the 2 core reasons for this market favoritism.
Yeah, because it's not just one single bullish driver. It's a unique, a 3-pronged confluence of tailwinds. And that's combined with fundamental structural weaknesses, well, almost everywhere else.
Okay, let's unpack that.
Yeah.
The core finding from your analysis is this idea of a 3-period resonance cycle, meaning you have positive drivers hitting simultaneously across the short term, the medium term, and the long-term horizons.
And that, crucially, is set against these structural issues, what the sources call the hidden worries, that are bogging down nearly every other major asset class from equities all the way to fixed income.
So connecting this to the bigger picture, it means the trade isn't just a vote for resources because they look great on their own.
No, not at all. It's also a powerful trade away from everything else because those assets look structurally challenged or maybe just overcrowded.
Resources have become the path of least resistance.
That's the perfect way to phrase it. The path of least resistance for these huge pools of capital that are just looking for performance.
Okay, so before we dive into the long-term logic, let's start with the immediate action. Your sources point to a major catalyst that really sparked this, something the broader market seemed to, completely underestimate.
That catalyst was the effect of the Federal Reserve's RMP. That's the Reserve Management Purchase.
And this was introduced back in the December policy meeting.
It was. And what's so fascinating is the market's initial reaction, or lack of reaction, when RMP was first announced. Traditional risk assets like U.S. stocks, bonds, even Bitcoin, they barely moved. They effectively neglected the potential for this immediate liquidity improvement.
And that's where the commodity market really showed its hand first.
Absolutely. While those other assets were just sitting there, metals launched this incredible run.
It started with silver, right?
Started with silver, then it quickly spread to gold and copper, and now we're seeing that momentum filter down into basic industrial metals, petrochemicals, even some agricultural products. It's a strong signal.
A signal that the resource market saw the liquidity injection from the RMP before pretty much anyone else did.
That is the key takeaway. The liquidity boost wasn't spread evenly. As the sources put it, it wasn't rain and dew for everyone. It was highly selective. And that selectivity brought capital straight to the sector with the fewest hidden worries.
Speaking of hidden worries, let's talk about the alternatives. We need to understand why capital feels like it has to leave other sectors. Let's run through the key stresses, starting with equities. What's making investors so nervous about the stock market?
Well, even the U.S. stock market, which seems invincible, has these significant underlying concerns about potential overinvestment.
In what way?
Your source highlights a growing deviation between AI capital expenditure, the massive dizzying spending we see, and the expected return on invested capital, the ROIC.
So why does that matter to an investor?
It matters because it suggests that the current growth is so heavily reliant on just burning through capital and future speculation, not efficient immediate gains.
Not actual profitability.
Exactly. That disconnect is a classic warning sign of a potential bubble, and it's making institutional investors very nervous about how sustainable this run is.
Okay, and what about global equities? If U.S. stocks are priced for perfection, what's happening overseas?
European stocks are fighting fundamental economic weakness, and their ability to respond is hampered by political uncertainty. Even when there's a push for fiscal easing to stimulate growth, political divisions are making that really doubtful.
Policy gridlock.
Pretty much.
Yeah.
And then you have Japan, which is dealing with a very different, very complex kind of policy conflict.
What's that?
Well, for Japanese stocks, you have this extremely challenging situation where monetary tightening, the central bank finally trying to normalize rates, is directly conflicting with continued fiscal easing.
And the result of that is?
A real risk of stagflation. It comes from the currency depreciating while there's no real significant industrial upgrading. It's a tightrope walk.
And emerging markets. I assume they're feeling the pressure.
Oh, yeah. They're struggling with the fundamental impacts from global tariff uncertainty. On top of that, the recent slowdown in the weak dollar narrative that's choked off some of the crucial capital flows they rely on.
So across the board for equities, it's uncertainty, overextension, or conflicting policy. But traditionally, when stocks get rocky, capital rushes to bonds. Why aren't bonds the safe haven right now?
Major country bonds face a shared and, frankly, a colossal pressure. Massive supply increases driven by fiscal expansion everywhere.
So governments are just issuing tons of new debt.
At an unprecedented rate. This concentrated supply shock, just the sheer volume of new government bonds hitting the market, is expected to directly suppress bond prices. It sort of eliminates the stability you'd normally expect from fixed income.
And even within the resource space itself, oil isn't leading the pack.
Correct. Crude oil, based on the source analysis, is generally overlooked. The market is just too focused on an entrenched supply-demand surplus. It just doesn't have the scarcity narrative to attract that critical allocation capital.
Okay, so that summarizes the first half of the story. You have overextended stocks, oversupplied bonds, surplus oil. And so precious metals and industrial resources naturally became the most appealing, the lowest friction place for all this global capital to go.
But like you said, that's only half the story. The second reason, and maybe the more crucial one, is that triple stack tailwind, the three-period resonance cycle.
Let's start with the immediate cash flow. The short-term driver is all about liquidity and policy shifts. We mentioned RMP, but we need to talk about the sheer scale of this.
It's incredibly significant because you have the RMP and the TGA, the Treasury General account releasing funds at the same time.
For listeners, the TGA is basically the government's checking account at the Fed, right?
Exactly. And when that TGA balance drops, that cash gets injected back into the financial system.
So you combine the RMP and the TGA releases. How much cash are we actually talking about?
Collectively, they're expected to inject at least $600 billion in liquidity. That's about $220 billion from RMP and another $400 billion from the TGA.
So it's not a new QE, but it acts like one.
Well, think of it more like unclogging two major financial drains at once. The combined release is what matters, and it helps bring bank reserves back to a more comfortable level.
And beyond that immediate cash, investors are still betting on more loosening from the Fed down the line. Rate cuts, maybe even more QE. Why is that expectation so sticky?
It's fueled by the K-shaped U.S. economy. On the top half of that K, you've got high-income groups, the AI sector. They're driving all the resilience. They're doing great.
But the bottom half?
The bottom half, well, employment quality for everyone below that high-income level is deteriorating, even if the headline unemployment number looks low.
Which creates a strange macro environment. Weak inflation, weak employment structure.
Precisely. And the consensus view is that only a really significant, truly redistributive policy shift like large-scale government support or direct cash subsidies for middle and lower income groups could heal that K-shaped divide.
And until that happens.
Until that major fiscal move happens, the market is convinced that the Fed will eventually have to loosen monetary policy to avoid a deeper economic fracture. And that anticipation just keeps capital flowing into inflation-resistant assets like resources.
Okay, that covers the short term. Moving to the medium term, we see two powerful fundamental factors aligning. First up is new demand from emerging industries.
Yeah, this is the structural foundation for the whole thesis. The rapid growth of new energy, so renewables, batteries, EVs, and the massive build-out needed for AI infrastructure. This provides core, non-cyclical support. These technologies are just incredibly material-intensive.
The IEA predictions in your source are pretty striking. They forecast global copper demand to increase by over 20% by 2030. A 20% jump in just 6 years. That's massive.
Yeah.
Where's all that copper going?
We're not talking about, building a few more washing machines. The primary sources are these massive utility-scale electric grid projects, the ongoing switch to electric vehicles, and, critically, solar energy build-out.
So every solar panel, every charging station.
Every single one. Every grid upgrade needs tons of copper. And the same logic, by the way, applies directly to silver, which is essential for solar cells and high-end electronics.
The second medium-term assist is the weak dollar cycle. What's driving that, And why does the market think it could last until, what, 2027?
It's driven mainly by the narrowing interest rate differentials, between the US, Europe, and Japan. As other central banks catch up, the incentive to hold dollars just for the yield gets smaller.
And that's coupled with pressure on U.S. growth itself.
Right. The midterm debt cycle constraints make dollar depreciation seem structurally inevitable over the medium term.
So that 2027 timeline isn't just a random guess.
No, not at all. Historically, these debt and currency cycles operate on multi-year timelines. The expectation is that the dollar will stay relatively weak for several years, offering continuous support for commodities, which are, of course, priced in U.S. dollars.
A weaker dollar makes commodities cheaper for everyone else, pushing prices up.
That's it.
Okay, finally, we hit the longest runway for this whole thing. Geopolitical tension. How does global conflict factor into resource scarcity?
It elevates their strategic importance dramatically. It turns them into tools of statecraft, of national security. We're seeing more and more countries, including essential industrial metals, copper, lithium, not just gold, in their strategic reserve lists.
And this leads to stockpiling.
Yes, this simultaneous global push for stockpiling on one hand and implementing export controls on the other, it just severely tightens the supply constraints.
And this is all tied to shifts in global power dynamics.
Absolutely. Your sources highlight the possibility that the Venezuela event might signal a strategic contraction by the U.S. in the Western Hemisphere, a region that is critically rich in resources like lithium and copper.
And a U.S. contraction there could make it much harder for other nations to get those resources.
Significantly harder for nations in the Eastern Hemisphere, yeah. It effectively increases the scarcity premium, regardless of what the economy is doing.
And the risk of supply disruption only grows in areas with power vacuums.
Precisely. Any acceleration of, say, a U.S. withdrawal from the Eastern Hemisphere could create power vacuums in places like the Middle East and Africa. That, in turn, escalates regional conflicts and just amplifies supply risks globally. It creates a long-term geopolitical floor under these prices.
That is a powerful, multi-layered thesis. So resources are sitting on this very strong foundation. But for you, the listener, the critical question is always, what are the specific road signs that would signal this whole thing is peaked or is about to reverse?
That is the most important piece of this. The whole bull thesis is only valid if these core drivers do not reverse. So we need to look for specific anti-signals across all three periods.
Okay, let's start with the short term. What are the immediate warnings that the liquidity trade is ending?
Okay, we have 4 immediate warnings. First, you look for regulatory intervention. This means major exchanges start tightening speculative controls. So raising margin ratios or imposing trading limits, that would be a huge red flag.
Or what about economic data?
Second, a definitive U.S. data reversal. We'd need to see an unexpected, super strong increase in core economic data. I mean, specifically non-farm payrolls and inflation. That would radically change the Fed's thinking away from easing.
Okay, and the 2 policy-related warnings.
Third, policy that fixes the K-shape. The successful, definitive implementation of highly redistributive policies like direct cash subsidies for ordinary citizens, that actually heals that K-shaped divide. That would lessen the pressure on the Fed to keep things loose.
And finally, capital would need somewhere else to go.
Exactly. Fourth, relief for other assets. Significant relief in those deep-seated concerns around other assets, especially U.S. stocks. If we see unexpectedly strong earnings reports that really justify all the AI spending and ease those ROIC concerns, capital will flow right back to growth stocks.
And what about the medium-term factors, demand and the weak dollar? What could challenge that?
There, we need to watch for a sustained return to political turmoil and prolonged economic stagnation in non-U.S. economies, so Europe and Japan. That would break the demand recovery logic, and it would also likely push the dollar back up as a global safe haven, suppressing commodity prices.
Okay, the long-term driver is geopolitics, which seems like the hardest one to reverse. Your source suggests global stability would do it, but is that level of stability even possible right now? Does the scarcity thesis still hold if instability is just the baseline for the next decade?
That is a fundamental challenge to the reversal idea. The long-term reversal sign would require global geopolitical clarification and stability, a kind of de-escalation that the market just doesn't expect right now.
So what would that look like?
It would involve the major powers ending their resource competition because they've successfully stockpiled enough reserves and created long-term backed-up production capacity. If supply security is actually achieved, then that strategic premium evaporates. But as you suggest, achieving that seems like a very, very long road.
That's a powerful thesis. If these core logics hold true, then we may really be in the strongest momentum phase for resource commodities in this cycle, solidifying their position as the sharpest spear.
And understanding this confluence of short, medium, and long-term forces is critical for you, the listener. I mean, when traditional assets are weakened by debt and overinvestment risk, the assets tied to the future of energy and technology, they just naturally dominate.
Which raises an important question for you to think about. Considering this fundamental shift from simple commercial value to strategic geopolitical necessity, how will the increasing military and national security designation of commodities fundamentally change the global pricing mechanism for metals like copper and lithium over the next 5 years? Will scarcity, rather than the cost of production, permanently become the dominant price setter? It's something worth exploring further.
Thanks for diving deep with us.